Gold just hit $4,680 an ounce, and central banks are buying faster than at any point in recorded history. While everyone watches the Fed, here's what governments around the world are actually doing with their gold reserves, and what it tells us about where this market is truly headed. Let me be direct with you from the start. The Federal Reserve gets all the headlines. Every rate decision, every press conference, every dot plot gets dissected in real time. But while retail investors are watching Jerome Powell, sovereign governments are moving billions into physical gold, and they have been doing it quietly for over 3 years now. This is not speculation. The numbers are in the public record. You just have to know where to look. Let's start with the single most important data point most financial media is not telling you. In 2022 and 2023 combined, central banks globally purchased over 2,000 tons of gold, the highest two-year total since the data was properly compiled going back over 50 years. That is not a rounding error. That is a structural decision made at the sovereign level across dozens of countries simultaneously, and it has not stopped. China's People's Bank of China officially holds around 2,280 tons of gold as of mid-2025. But here is the part they bury in the footnotes. China's official figures are widely believed to underreport actual holdings by a significant margin. Independent analysts tracking import data and refinery flows estimate China's real position could be 3 to 4 times the official number. Think about what that means when those reserves are eventually disclosed. The gold market reprices overnight. Russia is a similar story. After Western sanctions were imposed following 2022, Russia accelerated settlement of energy trades in non-dollar assets, and gold sits at the core of that strategy. Russia's central bank holds approximately 2,340 tons, making it one of the 5 largest sovereign holders in the world. More importantly, Russia's reserves are almost entirely held domestically, outside the reach of any Western freezing mechanism. That is not a coincidence. That is a deliberate architecture built over more than a decade. Now let's talk about the story almost nobody is covering: India. India's Reserve Bank added 72 tons of gold in the 12 months through early 2025 alone. India now holds over 840 tons in official reserves, with a growing share of that held on domestic soil after the Reserve Bank repatriated over 100 tons from the Bank of England in a move that was barely covered in Western financial media. When a country moves gold home from an allied nation's vault, that is a signal. It means they no longer fully trust the counterparty custody arrangement in a world of rapidly shifting alliances. Poland is another case worth watching closely. Poland's central bank purchased 90 tons in 2023, one of the single largest national purchases in a calendar year by any European country in modern history. Governor Adam Glapiński stated publicly that Poland was targeting 20% of its reserves in gold, citing geopolitical risk and the need for assets that carry no counterparty liability. His words, "Gold is the safest asset in the world," not from a French commentator, from a sitting central bank governor in Europe. Turkey has been one of the most active buyers and sellers, which tells its own story about how governments use gold tactically. Turkey bought heavily, sold heavily during its lira crisis to support the currency, then resumed buying once the pressure eased. This is gold being used as a sovereign liquidity buffer, a reserve that can be deployed in a crisis and rebuilt in calmer periods. Turkey's official holdings are now back above 600 tons, and their experience is a template other developing market central banks are studying. Now let me bring in the Japan angle, because it connects directly to where yields and gold are heading next. Japan's latest inflation data has made a Bank of Japan rate hike in September almost impossible to avoid. Japan has held rates near zero for decades, and its government has been the single largest foreign holder of U.S. Treasury bonds, sitting at over $1,100 billion. If the BOJ raises rates meaningfully, Japanese institutions will have a reason to repatriate capital back to yen-denominated assets. That means selling U.S. Treasuries. If U.S. Treasuries sell off, yields rise, the dollar faces pressure, and gold, which has an inverse relationship with real yields, gets another structural tailwind. Goldman Sachs published analysis this week arguing that slowing U.S. inflation is the cleanest path to lower yields. The Fed funds rate sits at 3.63% right now. If inflation cools and the Fed cuts, you get lower real yields. and lower real yields are the single most reliable historical driver of higher gold prices. The macro setup is not pointing in one direction. It is pointing in one direction from multiple angles at once. A lot of you have been asking where gold goes from here, and I want to give you a real answer rather than a number pulled from the air. Several of you asked specifically whether we hit $5,000 by end of 2026. Here is my honest read. The question is not really about gold at all. It is about what governments and central banks do next. If sovereign buying continues at the pace set in 2022 through 2025, if the dollar continues its slow structural decline against a basket of emerging market currencies, and if real yields fall as the Fed begins cutting cycles, then the $5,000 level is not a fantasy target. It is a logical output of the arithmetic. Gold has moved from around $1,800 to $4,680 in roughly 3 years. The forces that drove that move are not reversing. They are accelerating. But here is the thing I want you to sit with. The mainstream narrative still frames gold primarily as an inflation hedge. That framing is outdated and increasingly wrong. Central banks are not buying gold because they are worried about US CPI, which sits at a 332.813 index reading right now. They are buying gold because they are restructuring the architecture of global reserve assets away from dollar-denominated paper and toward assets with no counterparty risk. The IMF's own data shows that the dollar's share of global central bank reserves has fallen from around 71% in 1999 to approximately 57% today. That is 14 percentage points of the world's reserve allocation quietly walking out the door. Most of that is not going into euros or yen. A meaningful share is going into gold. US real GDP growth is running at just 1.5% right now, barely above stall speed for the world's largest economy. A weakening growth outlook historically compresses real yields, it pressures the dollar, and it increases institutional demand for non-sovereign assets. Every single one of those outcomes is a tailwind for physical gold. This is not one tailwind, this is a convergence. So what does sovereign behavior signal for the price of gold going forward? It signals that the buyers with the deepest pockets on earth, the ones who move markets over years not days, have already made their decision. They are not waiting for a dip. They are not watching technical charts. They are accumulating at $4,680 and above because they believe the asset they are buying will be worth significantly more in the monetary system that is being built around them. The question every viewer needs to sit with is simple. If the institutions that issue money no longer fully trust each other's paper, what does that tell you about the paper you are holding in your own portfolio? Before you close this video, here's what most people who watch once and leave miss. This channel publishes sovereign buying data, macro signals, and institutional moves every single week, connected into one clear picture. Subscribe right now and hit the notification bell so you never miss the analysis when it matters most. One thing I want to be upfront about. I am not a financial advisor, and nothing here is personalized advice for your situation. Most people consuming financial content never hear that said plainly, so I will keep saying it. Do your own research, challenge what I am telling you, and come to your own conclusions. What I can promise is that every number and data point you heard in this video is sourced and verifiable. This is one honest perspective on where the evidence points, not a prescription for what you should do. The smartest move you can make is to keep asking the questions most people never think to ask. One more thing before you go. I'm not a financial advisor, just a fellow student of the markets sharing what I'm learning. Always worth forming your own opinion.